Welcome to the Wealthfinity channel. In this video, we're going to dive into the world of personal finance and show you how to take control of your money and build wealth for the future. Whether you're just starting out or are a seasoned pro, you'll find valuable tips and strategies that will help you reach your financial goals. So sit back, relax, and let's get started on the path to financial freedom. Inflation is an economic concept that refers to the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. In other words, as inflation increases, each unit of currency buys fewer goods and services. Consequently, inflation erodes the real value of money. This can have significant implications for individuals and businesses, as well as for the overall economy. In the United States, the inflation rate is tracked by the Bureau of Labor Statistics, BLS, through the Consumer Price Index, CPI. The CPI measures the average change over time in the prices paid by urban consumers for a market basket of goods and services. Historical rates of inflation can provide valuable insights into the broader economic trends and conditions of a given time period. By understanding how inflation has changed over time, individuals and businesses can make more informed decisions about their spending, saving, and investing. Historically, the rate of inflation has fluctuated greatly. In the United States, for example, the rate of inflation was relatively low in the late 19th and early 20th centuries, averaging around 1 to 2%. However, this changed during and after World War II, when inflation rates skyrocketed to over 20%. One of the main causes of this spike in inflation was the government's decision to print large amounts of money to finance the war effort. This led to a decrease in the value of money and an increase in prices. Additionally, the post-war economic boom, also known as the Roaring Twenties, contributed to rising prices as demand for goods and services increased. In the 1960s and 1970s, inflation rates remained high, averaging around 4 to 6%. In the 1970s, however, inflation began to rise, reaching a peak of 13.5% in 1979. This period, known as the stagflation era, was characterized by high inflation and high unemployment. This was partly due to increased government spending on social programs and the Vietnam War. Additionally, the OPEC oil embargo of 1973 led to a significant increase in oil prices, which in turn, caused a ripple effect on prices of other goods and services. The Federal Reserve, under the leadership of Paul Volcker, raised interest rates to combat inflation, which helped bring inflation rates down to more manageable levels in the 1980s. The Federal Reserve has a target inflation rate of 2% per year, as measured by the Personal Consumption Expenditures, PCE, price index. Since the 1980s, inflation rates have generally been on a downward trend. This is due to a variety of factors, including monetary policy changes by the Federal Reserve, technological advancements, and increased globalization. In recent years, the rate of inflation has remained relatively low, averaging around 2%. In the 1990s and early 2000s, inflation remained low, averaging around 2% per year. However, in the wake of the 2008 financial crisis and the subsequent economic recession, inflation has remained low, averaging around 1.5% per year. It's important to note that inflation can have different effects on different segments of the population. For example, those on fixed incomes, such as retirees, may be disproportionately affected by inflation as it erodes the purchasing power of their savings. On the other hand, businesses that are able to pass on higher costs to consumers may be less affected by inflation. Therefore, it's important for investors to keep an eye on inflation rates and consider strategies to protect their wealth, such as investing in assets that have the potential to maintain or grow in value, even in an inflationary environment. In conclusion, the history of inflation rates in the United States has been marked by fluctuations, with periods of high inflation and periods of low inflation. The causes of inflation have varied throughout history, from wars and natural disasters to monetary policy and economic growth. Understanding the past can help us predict and prepare for future inflation, and make more informed decisions about monetary policy and personal finance. As the video showed, it is important to keep an eye on inflation rates and to understand their impact on the economy and our daily lives. Overall, the history of inflation rates in the U.S. provides valuable insights for anyone interested in economics and personal finance.